for example. Okay, so at the point of time, the book value is 183 billion. There's 3 billion, 3.9 billion shares. So if we divide, right, your book value per share is $46. Okay, so this is basically the book value per share. What we want to do is we want to invest lower than the book value per share. Okay, very straightforward. So you can see over here, okay, this is back in 2011. Okay, book value per share is 46. So if the share price is lower than this number, it means that it's undervalued. If the share price is higher than this value, it is overvalued. Okay, you understand this? If you understand, type U. Quite straightforward lah. Okay. To make it even simpler lah, today I have a $10 note. I want to sell it to you. How much will you buy this $10 note from me? You want to buy less than $10 lah. Okay, even if it's $9.90, you don't mind lah. You make 10 cents. Alright, but of course, like I said, when it comes to investing, we spend the time and effort to make that 10 cents a bit pointless, right? So that is why when we use asset play, we want to make sure that we buy them 20% below the book value. So which also means that when I take the share price divided by the book value, it should be less than 0.8 lah. That means 20% discount lah. Okay, so we use a $10 note example. If I have a $10 note, you want to buy from me, how much should you buy from me? Less than what price? Less than what price? Yes, exactly, less than $8. Okay, less than $8. So for example, right now the share price is $7. Okay, also the stock price, you can see the P, right? The P over here. You're going to buy $7. Okay, and then I give you the $10 note lah. So the book value, the $10 note is like my book value per share. 7 divided by 10 is 0.7. Is this less than 0.8? The answer is yes. So if the answer is yes, means it's undervalued. That means can buy. Okay, so very, very straightforward. So whatever is the book value per share, you minus away 20%. If the share price is less than that, it means that it is undervalued. So now we're going to look at two examples. Okay, one is Prudential Financial and the other one is Bank of America. So I'm going to just demonstrate one time, okay, on Prudential Financial. Then later on, you guys are going to do Bank of America, okay, for this practice. So what I'm going to do right now is I'm going to go back to my Safari, okay, to show you guys exactly how to do it. So first we go to our Cheetah. Okay, then we go for Prudential Financial. You can see it's the first one. Prudential Financial. Then we go to our fact sheet. So over here, okay, very importantly, just now we have put in the eFriend. Okay, eFriend. But we want to add in one more thing, customize. We want to add in book value per share. Okay, book value per share. So once you have selected, remember to update spreadsheet. So after you update spreadsheet, okay, then you can see it's actually over here, 44.4. So what you want to do is, okay, so let me just put this number into the spreadsheet also. Okay, I'm going to put it into Prudential, PRU. Okay, let me just new share. Okay, so this is Prudential. So right now, let's take a look at the share price. What is the share price of this company just now? What is the share price? Where's my Safari? Oh, okay, let me just take a look. Okay, my Safari is here. Okay, the share price of this company right now is 82.05. Okay, so I put the current price at 82.05, and because this is a bank, so I'm going to put it as asset. And what happened is that, okay, we just go all the way to the right hand side first, which is under valuation. Let me just zoom up. Okay, so you can see if it's under asset, we just focus on the asset. Okay, under BVPS, book value per share. So we put in the number just now, 44.4. Okay, 44.4, right? Am I correct? Yes, 44.4. So now, if I were to go back to my spreadsheet, you all will realize, okay, this is automatically calculated. So if I want to enter, technically I should enter 20% below the book value per share, which is $35. But right now, the share price is $82. So is it undervalue or overvalue? It's overvalue. Okay, overvalue. Okay, very important question about this one. I must answer. If not, I cannot sleep tonight. Okay, AQ is asking, why would a company want to sell below valuation if they are still profitable? So you have to understand, the company, right, doesn't control the share price. What control the share price? Okay, what contribute the share price to go up and down? Y'all make a guess lah. What causes the price to go up and down? Actually, right, it's you and me lah. Okay, if today I got a lot of money, I keep on buying at a higher price, then the share price will go up lah. If because of fear of the market, of the banking sector, I'm very scared, I keep on selling, then of course the share price will keep dropping. But share price drop doesn't mean that the business is not doing well. So that is where opportunity is. For example, I always say that in a war time, let's say today there's war, okay, or there's recession, McDonald's, the share price keep dropping because when the recession comes, everything will drop, including McDonald's. But does it mean that nobody is going to the McDonald's? Does it mean that McDonald's is not doing well? No. In fact, you realize that in a recession, more people go and eat McDonald's because they're very stressed. Then they like to eat unhealthy food, okay, at least for me, okay. When I'm stressed, I eat unhealthy food, like KFC. Okay, now you know why I stress, okay. Yeah. So, again, right, business doing better than before. But because of the investor sentiment, share price drop. What is this? This is opportunity. Because why prices is being controlled by investor. But business is still business. Okay. So this is not within their control. It's not within their control. So I hope you have a better understanding. Okay, so I'm going to give you guys a little bit of time to go through the second company, which is on Bank of America. Okay, so let's see how much time you all need. I'm going to give you, because it's the first time that you are doing it, so I give you a little bit more time. Okay, so 8 minutes to do this exercise. Okay, 8 minutes. Okay, so you'll put it in under over here, BAC. The ticker symbol is BAC. Go to JITA, go and put in your book value per share. Go and fill in the column. If you have time, also go and fill in all the EFRAN. Okay, also go and fill in the EFRAN. Because remember, by right, before we even go to the valuation, this is a company that must be 7 and above. It's a good company, then I look at the valuation. If it's a bad company, do I want to look at valuation? Or do I want to buy a bad company that's very, very cheap? The answer is no. Because remember, cheap can become cheaper, right? So right now the time is 3:23. So come back at 3:30 sharp. Everybody type in 330. All right. So go and complete the BAC. Then later we come back. Maybe I'll get one of you to share with us, okay, your answer. We do a quick hot seat, okay, and then we move on to the second valuation method. All right. See you guys back here at 330 sharp. See you later. Let's go. right, so how many of you have already completed? If you have completed, type C. C for completed. Okay, and then I'm going to invite one of you, right, to come out for the hot seat. Okay, but I'm going to let you self-volunteer. How many of you want to come out for the hot seat? And if you come out, I'm going to let you ask a question also, any question that you have. If you want to come out, type HS, hot seat. Okay, I can only have one. Okay, so if you want, you have to grab the opportunity already. HS. Yeah, if nobody, then we will not do the hot seat. Okay, final chance. 3, 2, 1. Okay, don't have. Okay, then we will just continue. Okay. Okay, so let's look at the spreadsheet itself. Okay, can show the PowerPoint for valuation method 1. Okay, yeah, later I will go through again. Okay, so now I'm going to go through the BAC, okay, using the JITA itself. So let's go to my Safari. Okay, so we go to BAC, Bank of America. So remember earlier on I talked about going to the fact sheet, and once we go to the fact sheet, we look at the book value per share. So for example, for Bank of America, the book value per share is 30.6. So when we go to the spreadsheet, okay, spreadsheet itself, 30.6, right? We have to put it over here. Okay, let me just reshare this. I think you're not able to see my screen, right? Okay. New share spreadsheet. Okay, wow. I forget the number. What's my number again? 30.6. Okay, so I go to 30.6. I go to valuation under the last one, 30.6. Alright, so the rest, you don't have to change anything. This is default 0.8. Alright, then of course, BAC, you have to put it under asset. And we have to go and find the current price as well. So let's take a look at the current price of BAC, 27.2. Alright, 27.2. Okay, so wow, very, very important. Do you all see anything? What do you all see? The current price is 27.2, and based on my entry is 24.48. So can enter or cannot enter? Okay, the formulation doesn't work. So if the formula doesn't work, maybe you can re-download, okay, or you can actually select the asset. You need to select the type in order for the number to actually appear. Alright, so cannot, right? Because why? It is still overvalued. Okay, can you see? I want to buy below 24.48, but right now, the price is 27.2. But what if I tell you that there's actually a strategy that allows you to potentially buy at 24.48, and while waiting for the price to drop, you get paid? How many of you think that this is amazing? That is potentially, you can, while waiting for the price to drop, you get paid pocket money. If you think this is a good strategy, can you help me to type BOSS? Some of you already learned before, right? But for those of you who are totally new, okay, when I first learned, I'm like, wow, what kind of strategy is this? It sounds too good to be true. Okay, yeah, but this is exactly the strategy that Glenn, as well as myself, okay, I think previously for the past few months, right, we have been doing this most of the time to collect pocket money, 24.48. How do we actually get this? Okay, very simple. This is done by the formula. Okay, and of course, how do we get 24.48? We take the book value per share, okay, times 0.8. So if you take out your calculator, you put 30.6 multiplied by 0.8. Actually, you get the correct answer, 24.48. But this one is formula will calculate for you. Alright, very, very straightforward. So let me go back to my Bank of America. Okay, so again, we have not gone through BOSS because that one is actually an option strategy, which over here actually we cover mainly on valuation, on fundamental analysis. Alright, but I think earlier on, Glenn actually shared with all of you one of the very, very powerful strategy, which is actually on buying call option. Alright, but later on, I think if there's chance, if there's time, maybe I can talk a little bit about BOSS, but no promise because I think right now we are already a little bit over time. Okay, so just now Glenn over lunch also keep on trying to psycho me to share with all of you, okay, but I say that if there's time, then I will talk a little bit about it. Okay, if you think it's fair, type fair. Okay, let me go through because I want to go through the main syllabus first. This is what you guys have actually signed up for, so I want to make sure that all these are being covered before 4 p.m. So the next valuation method, right, is actually on dividend. Okay, so again, this will be very, very useful for company that are giving dividend, but not just normal dividend. We want to make sure that the business give out consistent dividend. That means every single year they give out dividend. Okay, so if these companies sometimes they give, sometimes they don't give, then for me, I wouldn't even classify this as a dividend company. You get me? Okay, so I need to make sure that number one, the dividend is consistent, and if possible, it should be either throughout all the same amount or it should be increasing slowly. Okay, that will classify as a good dividend company. So some of the things, right, for example, you need to take note. This is Coca-Cola. You can actually see from the left-hand side to the right-hand side. You can see that not only is Coca-Cola giving dividend every single year, the dividend is increasing year on year. Why is this powerful? Okay, I want you to start thinking about this. You can see 2005, the dividend is 0.56. Okay, this is the absolute amount, not percentage, absolute amount. Okay, so 0.56. 2012, or rather 2013, they are giving 1.12. So it's almost like a 100% increase in 8 years. So some of you might feel that that's not a lot. I mean, 8 years, 100%. But I want you to imagine, if let's say back in 2005, your dividend yield is 5%. That means every year, right, you're already collecting 5%, 5%, 5%. And just by holding on to this company for 8 years, right, now your dividend is no longer 5% every single year. It is actually 10% every single year. So can you imagine every single year you're getting 10%? And that's also not inclusive of the capital gain. I'm just talking about based on your original amount that you're invested. At first you're collecting 5%, but because the dividend keep on increasing, now you're collecting 10% every single year. Now the best thing is this 10% going to stop here? It is not going to stop here. In fact, this is 2012. Imagine in 2020, the $1 become $2. So now you're getting 20% every single year. Like, can you imagine you put $10,000 and now every year you're getting 2,000 back just on dividend alone. So that's exactly why, right? Warren Buffett, he invested into Coca-Cola over a very, very long period of time. And today, the dividend that he collects alone in a single year is more than the original capital that he had put in many years ago. Just in one single year, dividend alone, more than the amount that he has invested many, many years ago. That's because he has held it for a very, very long period of time. Very good question. Will we get tax for dividend received? The answer is yes. For US stock, right, dividend you get tax 30%. Okay, but of course, this is something for us to take note. You don't have to file it in your own income tax. The amount of money that you collected, it will automatically be deducted off dividend. I mean, it will be deducted off the tax. So let's say originally you're supposed to collect $100. So they will automatically take away $30 as tax. They will send you $70. So it's already pre-deducted. All right, just for us to take note. Okay, so let me just move on. So how do we actually look at the valuation, right? We calculate this thing called dividend yield. Okay, dividend yield. So we take the dividend per share divided by the share price. Okay, the dividend per share divided by the share price. So what is the dividend yield that we want to focus on? You can see we want to buy them above 5%. That means if the company dividend yield is less than 5%, then it's overvalued. If the dividend yield is more than 5%, that means it is undervalued. All right. So I think this is very, very straightforward. So let's take a look at some of the things to take note. So usually for dividend per share, we will always use the last dividend because that is the most recent number, the most recent amount that they are distributing out. So you don't have to use the previous number. And one thing to take note, right, is that if the latest dividend is much higher than the previous year, then we should also be conservative and use the number from the previous year. So for example, over here, this is considered pretty consistent. 0.5, 0.52, 0.55, 0.57, 0.58. So there will be times whereby maybe 0.58, suddenly, right, they give out $1. So there's a spike, there's a jump. Okay, so if you use the $1, then you realize that, wow, suddenly the dividend yield is very, very high, maybe 8%. Then you thought it's undervalued. But what happened is that, right, there are times whereby the company will give out this thing called one-time dividend, okay, or special dividend. So usually when does it happen, right? It happens when the company sold off maybe one of the asset. Maybe they got a factory, they sold it off, then because of the money that they collected, they distributed some of the profit from this asset back to the investor. So they put it under a one-time special dividend. So that's why the dividends spike up. But very importantly, do they sell factory every single year? The answer is no. So the following year, the dividend will go back to the normal amount. Right? So again, if you use the higher number, the percentage will be fake. It will not be an accurate number. If you understand what I meant, can you type U? Okay, so for example, over here, right, 0.2, 0.2, suddenly 0.79. Something is wrong. So when we do our calculation, we will still take 0.22 instead of 0.79. So this is the thing for us to take note. So same thing. Okay, I'm going to go through an example for Walmart, and then later on we will also get one of you to showcase the 3M as well. Right. So let me show you, okay, when it comes to Walmart, how are we going to look at it? So same thing, we go to our fact sheet under JITA. We will customize and we will look for dividend per share. Can you see dividend per share? So once it's in, update your fact sheet. So you can see it will appear over here. So for example, this is Bank of America. Okay, so we use a dividend company. So for example, I use Walmart. Okay, Walmart as an example. So under Walmart, under the fact sheet, you can see the dividend per share is 2.24. Okay, so before we even go and do the calculation, make sure that you can see, is the dividend consistent or not? Can you see? 1.88, 2, 2.04, 2.1, 2.2, 2.24. Well, every year they are increasing the dividend per share, 2.24. So let's go to our spreadsheet. Okay, let me just go back to the spreadsheet. 2.24. We put it over here, Walmart. So this is dividend play. We put dividend. And then we scroll all the way to the right hand side. Okay, under expected dividend, we type in 2.24. Enter. So over here you can see, right, I actually increased from 5%, okay, to 6%. Some of your spreadsheet, maybe it will show 5%. Okay, but why is it that I put at 6% is because the current inflation, the current interest rate, okay, in the market is already pretty high. So even if, let's say today I put my money in the fixed deposit, right, some of the fixed deposit is already giving like 3.5 or 4%. So it doesn't make sense, right, for me to, let's say today I go and invest in a dividend company to earn 5% when I can put into something that is guaranteed at 4%. So as a result, okay, because now the interest rate is higher, the fixed deposit is higher, I want to make sure that if I invest in a dividend company, I get a higher dividend yield. Okay, that is why I put it at 6%. Right, and based on my 6%, you can see that my entry is 37.33. Let's take a look at the current share price. Current share price is at 151.8. Very, very high. Okay. So you know that based on dividend yield, this is way overvalued. This is way overvalued. All right, based on the dividend itself. So another shortcut that you can also use is you can also type in dividend yield. So this is shortcut. I also teach you shortcut. So shortcut also means that just by looking at this, right, you can see that right now the dividend yield is 1.6%. So actually from here, right, you already know that you will fail, okay, in terms of valuation. Right, pretty straightforward. So that is for Walmart. Let's take a look at the second company, which is 3M. Okay, I think I will just go through with all of you. This is 3M. MMM. But now y'all tell me whether is it undervalued or overvalued based on the shortcut. Based on the shortcut, is it undervalued or overvalued? still overvalued, but you can see that actually recently, right, because of the dip in the share price, the dividend yield is actually at 5%. So if the price continue to drop further, there's a potential that this 3M will become 6%. All right, and of course, if you look at the dividend payout, right, is it consistent? It's actually very, very consistent. Okay, from 3.4 to 4.7 to 5, and right now it's closing out to 5.96. Right, so this is actually for 3M itself. So actually from here is a very, very quick one. But of course, if you put into the spreadsheet, some of you are asking, how do I get the number? Okay, these are all formula. These are all formula. Of course, if you really want to go and know how to calculate the formula, actually you can calculate. Actually, the formula is all over here. Yeah, so basically very simple. You take the dividend per share divided by the current price. Okay, so for example, 2.24 divided by 151.88, right? 151.88. That is where I get the dividend yield of 1.4% because I get 0.014. So basically, you can do a reverse calculation. What is the price that I need in order for me to get 6%? You can actually go and reverse the formula, and that's where this entry price will come. Okay, so very simple. You take the entry price, okay, the expected dividend, divided by the entry price. This should give you 6%. Okay, you can take 2.24 divided by 37.33 and you get 6%. Okay, so this is the reverse formula. Okay, this is the reverse formula. So again, over here it's not a math class, so that's why we give you the formula. Okay, that's why we give you the formula so that you all don't have to crack your brain over the formula itself. Okay, of course, the even easier one is just put in the dividend yield within the JITA, and then you straight away can see whether is it undervalued or overvalued. Okay, so this is very, very straightforward. Any questions so far? If everything is okay, can you type in okay for me? Everything is okay, type okay. Okay, fantastic. All right, so let's move on to the last part before we take a short break, and then later on after the short break, I will invite Glenn, okay, to come back, and then we will have a short Q&A segment. That's where if you have any burning question, then you can still continue to ask us during the Q&A itself. So right now we want to talk about taking action, because why? We have already shown you how to look at good company, how to look at valuation, and what price is actually good to enter. But with all the knowledge, right, if you don't take action, then of course nothing is going to happen. Okay, life is not going to change. So if you look at the platform, right, there are actually a lot of platforms out there that deals with shares itself. Like DBS, Vickers, Moomoo, Think or Swim, Poems. Of course, today I'm going to just demonstrate these two platforms. One is Think or Swim. Okay, because I know some of you are also doing options. So if you're doing options, then Think or Swim will be one of the preferred platform. I think Moomoo is also pretty well known in the local scene. Right, so these are the two more common ones. Right, so I think all of us, we love free stuff. Okay, one of the best thing, right, why nowadays more and more people are investing is also because, right, the commission for stock is $0. Okay, the commission for stock is $0. So that is also why, okay, right now, if especially right, if let's say the share price is like, let's say $100 how much money do you need to actually get started? It's just $100. I'm sure everybody have got $100, right? Then you can just buy one share. So it's very easy for anyone to get started. Right, so of course for Think or Swim, you can start off with the web version. For the Moomoo, there's also a lot of paper account. If you have not created an account, you want to practice, you can also go to the paper trade to start practicing. All right, but right now, okay, I'm going to go to the live demo. So I do first, and then you guys actually watch how we do it. Of course, for those of you, right, who wants to rewatch it, if you have the recording, you can go and watch the recording as I go through. But I try to go a little bit slower so that everyone can actually follow me through. So I'm going to demonstrate maybe the first platform, which is on, let me just take a look. I'm going to demonstrate on